India's stock markets are about to witness its largest IPO ever. And the strangest thing is, it's not even an Indian company. Hey folks, you've tuned in to 7 Capital, and today we're going to talk about one of the most anticipated IPOs in India's stock markets, the Hyundai IPO.
India's biggest ever IPO, Hyundai
Motors, one of the biggest IPOs in the Indian history,
offering roughly 14.2 crore shares.
Will this listing boost India's stock market further?
If you like videos on finance, business, economy, and all things related to them, don't forget to subscribe to our channel. Back to Hyundai's IPO. So Hyundai Motors India, which is the subsidiary of the South Korean car manufacturer Hyundai Motors, is all set to launch its IPO on Tuesday, 15th October. The issue will close on 17th October. Why do we say it's the largest IPO ever in India's stock markets? Well, that's because Hyundai Motors is expected to raise over 27,000 crore rupees from this listing. That's bigger than any other public offering India has ever seen. The largest IPO till date was LIC, which raised 21,000 crores, and before that, Paytm, which raised 18,000 crores. So this is a massive deal. The company has set the price back at 1865 to 1960 per share. Now, many of you might be wondering, why is a South Korean car maker listing one of its subsidiaries in the Indian market? Other foreign car makers like Honda, Skoda, or Toyota aren't exactly lining up to do the same. Well, to understand that, you need to look at two things. A, what India means to Hyundai, and B, why the company is choosing to go public right now. India is the world's fastest-growing economy, and Hyundai has had a long history here. They entered the markets in 1998 with the iconic Santro. Today, Hyundai is the second-largest car maker in India, just behind Maruti Suzuki. For Hyundai, India represents a growing market for not just affordable cars, but also for the premium section. Hybrids, electric vehicles, you name it. Hyundai Motor India is a crucial piece of their global puzzle. Even though India only contributes 6 to 7% to the parent company's overall revenues, the South Korean company expects the India arm to contribute more to its bottom line in the coming years as India's economy matures. Currently, Hyundai India is a wholly owned subsidiary of the Korean company, which means 100% of Hyundai Motors India is owned by the South Korean company Hyundai Motors. But with this IPO, Hyundai Motors is selling 17.5% of its stake in the Indian unit. With this move, the parent company wants to give the Indian unit more independence in making growth decisions, particularly with new technologies like electric vehicles and hybrids. This way, they want to compete head-to-head with Maruti, Tata, and other Indian car manufacturers. But here's the catch. This makes this issue a complete offer for sale. What does that mean? Well, a typical IPO can be a fresh issue or an offer for sale or a mix of both. If it's a fresh issue, this means the money raised by the company through the IPO goes directly to the company. This way, they can put money into expansion projects and also pay debt. However, in an offer for sale, the existing shareholders, in this case the Hyundai parent company in South Korea, are simply selling a portion of their stake. The proceeds from this sale will go directly to the parent company, which means the 27,000 crore rupees raised here will go to the Korean company. This has sort of dampened investor interest a little because usually, investors like to see companies raise money to fund their growth plans. In Hyundai's case, Hyundai Motor India won't get any of the funds that they'll be raising from this IPO. That said, it's not all doom and gloom. Hyundai Motor India is sitting on over 8,500 crore rupees in cash reserves, and they've aggressively been investing in newer technologies. So despite the IPO structure, the company still has a lot of potentials to grow and innovate, especially since it's in a good position. But that's not the only concern of investors who've been tracking Hyundai's IPO. Many investors are paying close attention to the gray market premium of the company, and they're not happy with it. For those who are unfamiliar, the stocks of the company are also sold before the IPO. That happens in the gray market, and the gray market premium is used as a metric to understand the company's potential. Initially, Hyundai's GMP was quite high. It was at 400 rupees per share. But after the price band was announced, it dropped nearly 70%. It came down to just 1 rupee 45 paise per share, which implies a potential gain of maybe around 7%. Why did this happen? Well, the market thinks that the IPO is slightly aggressively priced. Some analysts believe that Hyundai India, while strong in the Indian market, is being overvalued. Despite contributing only 6 to 7% to the parent company's global revenue, Hyundai India is being valued at nearly 42% of the parent company's overall market cap. Hyundai's parent company is valued at around $45 billion, and the Indian company is going to be valued at around $19 billion based on the IPO. This disparity has made some investors cautious, and it's not like we've made up any of this information. A lot of these points are available in the media and in the company's red herring prospectus. Thanks for watching Seven Capital. If you found this video helpful, don't forget to like, share, and subscribe for more financial insights and updates. See you on the other side.